start with a really relatable question. Have you ever just stared at your screen wondering why a major pair, like, say, the Euro-US dollar, completely flatlines late at night? You end up trapped in this painfully slow trade, only to watch it violently spike the second the New York morning hits. It is incredibly frustrating, right? Well, it's definitely not random. It all boils down to time zones and knowing exactly when these massive global banking centers wake up and start pumping serious volume into the market.
Okay, let's dive into this real quick. There is a night and day difference here. Trading inside a designated kill zone, that means you're actually in the mix during periods of high volatility. The price is moving with real purpose. But trading outside of these active windows, honestly, you're just fighting market noise. You're getting chopped up in these tight, unpredictable ranges and battling absolutely terrible liquidity.
And that brings us to the core concept from our source material, the ICT kill zone. Coined by the Inner Circle trader, a kill zone is simply a specific time window when institutional traders, big banks, and hedge funds are most active. These are the hours with the absolute highest trading volume, the sharpest price action, and the biggest liquidity grabs. It's basically the hidden machinery of the market. It's when smart money executes their massive orders, and trust me, we want to be surfing right in that institutional wake.
So here is our roadmap across the 24-hour global Forex cycle. 1. The Asian kill zone. 2. The London kill zone. 3. The New York kill zone. 4. The London close. And 5. Strategy and shifting clocks.
Taking a look at the timeline here, you can see how this whole thing is essentially a continuous 24-hour relay race. Liquidity doesn't just sit there, it actually gets handed off from one major financial hub to the next. It kicks off around 2000 UTC with the Asian session, passes the baton to London at 0700, pushes right into New York at 1200, and finally sees its last major volatility spike during the London close around 1500.
Number 1. The Asian kill zone, midnight open and consolidation.
Shifting our clocks to Eastern Standard Time, which, by the way, is the anchor for all ICT concepts, the Asian kill zone runs from roughly 1900 to 2200 EST. This window is super interesting because it includes the midnight open. That's essentially New York's midnight, which serves as the true opening bell for the institutional daily candle. Now, during this time, overall volume is actually pretty low, which causes the price to consolidate into a tight Asian range. But don't be fooled by the quiet. What's actually happening is stealthy liquidity building. Small clusters of stop losses are just stacking up above and below this tight range, setting the absolute perfect stage for the rest of the day. If you're trading the zone, the Aussie dollar, New Zealand dollar, and Japanese yen pairs are definitely where the action is.
And this beautifully illustrates exactly what we're talking about. Look at how narrow the price action is in that highlighted area. It's just drifting sideways, consolidating, literally just waiting for the next major market to wake up and use all that built-up liquidity as absolute rocket fuel.
Number 2. The London kill zone. Volatility expansion.
Running from 02 to 5 EST, the London Open is where the market truly wakes up from its nap. The primary job of the London kill zone is to redistribute all that liquidity that was quietly piling up while Asia was sleeping. Institutional smart money steps in and actively hunts down those stop clusters above and below the Asian range. The result? A massive, sudden expansion in volatility. Spreads tighten up, and you get aggressive, directional momentum. This is absolutely the prime window for trading the euro, British pound, and Swiss franc pairs.
Number 3. The New York kill zone, the powerful overlap.
Spanning from 7 a.m. to 10 a.m. EST, this right here is the powerhouse session. Why? Well, because it features this massive overlap between the European banking desks, which are already firing on all cylinders, and the American desks that are just logging on. This transatlantic tug-of-war injects an insane amount of liquidity into the market. It makes it the perfect environment for trading US dollar majors, especially Euro-USD. Interestingly, price action here will very often retrace back into the range established by London before setting the dominant long-term trend for the rest of the day.
So the absolutely crucial point here is this exact time, 8:30 a.m. EST. If you are trading the New York kill zone, you literally need to burn this number into your brain. This is the precise moment when major U.S. economic data, things like CPI, non-farm payrolls, retail sales, drop to the public. When that clock strikes 8:30, market volatility absolutely goes through the roof. It creates the most aggressive, purposeful institutional price delivery of the entire session.
Check out how aggressive the price action gets here during this overlapping time frame. Compared to that tight, quiet consolidation we saw during the Asian session, this is explosive. You can actually see the sheer size of those candlesticks and the rapid expansion of price as all those overlapping institutional volumes hit the market at once. It's a total shift in gears.
Number 4. The London close. Profit-taking and shifts.
Occurring between 10 a.m. and 12 p.m. EST, this 2-hour window represents the final major injection of volatility for the day. At this point, European traders are packing it up, squaring off their positions to go home. And this mass exit leads to some serious profit-taking. That profit-taking frequently causes very predictable shifts in the intraday market structure. It's essentially your last really solid window to capture high-probability setups before the market just completely dies off into the afternoon dead zone.
Number 5. Strategy and shifting clocks. Navigating DST and execution.
Now, what's really interesting here is the impact of daylight saving time. The source material points out that while the US and the UK shift their clocks twice a year, which obviously forces you to adjust your New York and London kill zone trading times, Japan actually has no DST. Because of that, Tokyo timing never shifts. It remains this constant, permanent anchor year-round. It's a small detail, but absolutely crucial to remember so you don't accidentally show up an hour late to the European Open.
To prevent burnout and, avoid that classic trap of overtrading, the sources lay out a super simple focus strategy. Step 1. Just pick one major US dollar pair to trade during that massive London-New York overlap. Step 2. Pick one Asia-centric pair, like a yen cross, to trade during the Sydney-Tokyo overlap, if you're actually awake for it, of course. And Step 3. Choose consistency over the fear of missing out. You do not need to trade every single zone. Just pick the one that fits your local schedule and master it.
So, we've tracked this global relay race of liquidity, all the way from the quiet accumulation of the Asian session to those explosive, high-volume overlaps of London and New York. The data makes it crystal clear. Price action behaves fundamentally differently depending on the exact time of day. So I want to leave you with this question to chew on next time you open your charts. Are you actually aligning your trades with the market's institutional heartbeat? Or is your current schedule forcing you to fight a losing battle against the noise? Thanks so much for hanging out with me for this explainer. Keep your timing sharp out there.